Tricolor's bankruptcy.
First Brands files Chapter 11.
Regional banks plunge.
They tell you it's an isolated event, a single company, bad luck. But what if it's not? What if it's a pattern? What if it's a warning?
Mainstream is giving you the snippets. We're giving you the full scoop. This is only the beginning. Jamie Dimon, the CEO of the world's biggest bank, called it the Cockroach Theory. When you see one, you know there are more. This week, we saw them. The Tricolor subprime collapse, a multi-billion-dollar bankruptcy, now being investigated by the DOJ. Then the First Brands bankruptcy, another billion-dollar collapse. First, the financing machine breaks. Then, the parts machine breaks. This week, the regional banking index plunged over 9%. Coincidence? There are no coincidences. Welcome. This is your host, Josh Logan, and you are listening to Confessions of an Insider. This is the place where automotive strategy meets market reality, the ASMR edition. As you just heard, the dominoes are falling. This week was not about a single story. It was about connecting a series of seemingly isolated collapses to reveal a much deeper, systemic problem in the financial underbelly of the auto industry. So let's get right into it. Starting with the first domino to fall, the one that hit the most vulnerable consumers.
So, big news on Tricolor Auto Group. They've officially hit Chapter 7, liquidation.
Yeah.
And this isn't just, another subprime lender going under, which happens. The scale here and the fact that the Department of Justice is formally investigating, that points towards something potentially criminal, maybe large scale.
That's exactly right. So for this deep dive, what we want to do is unpack this story. It's really about financial contagion. I mean, just look at the bankruptcy filing.
What's the number?
It lists liabilities between $1 billion and $10 billion.
$10 billion. Wow.
Yeah. And you could really see this as, well, the result of what people are calling the great squeeze on consumers. High rates, inflation, pushing people towards riskier lending.
Okay, let's dig into that. Tricolor's model was always high risk, right? Targeting borrowers with bad credit or no credit at all.
Correct.
And the engine driving it was packaging these high-interest loans into securities, then using those as collateral for huge bank credit lines. So what was the core trick here, the main allegation?
It's this thing called double pledging. That's the fraud allegation at the heart of it.
Double pledging. Okay.
So, put simply, it's like, imagine you have one car title, just one.
Right.
And you use that exact same title to get 3 different big loans from 3 different banks.
Without them knowing.
Without any of them knowing about the others. That's basically what they're accused of doing with these loan portfolios. Using the same pool of loans as collateral multiple times over.
Whoa. So the banks weren't just taking on risky loans, they were lending against collateral that was, already promised elsewhere. Or maybe didn't fully exist for their loan?
Precisely. And this whole process of bundling the loans, securitization, it's complex. It seems that complexity helped hide what was going on.
Okay, and now the DOJ is involved? That really ramps things up.
It totally does. Yeah. This isn't just a business failure anymore. A formal DOJ investigation means they believe there's credible evidence of serious federal crimes. People could face real charges.
So the House of Cards falls. Who got caught holding the bag initially? We know some big names are involved.
Yeah, the sources point to 3 Wall Street players right off the bat: Fifth Third Bank, JPMorgan Chase, and Barclays.
Heavyweights.
Definitely. And the initial hit, estimate they're up to $200 million each.
So that's $600 million just between those 3.
About that, yeah. That's the initial known loss, hitting some very sophisticated firms.
But wait, if the total liability range goes up to $10 billion...
Exactly.
Then $600 million, while huge, sounds like it could be just...
the tip of a very, very large iceberg. That's what's so concerning. It suggests the financial damage goes way beyond just these first 3 banks.
Okay, so that's the financial side. What about the human cost, the actual borrowers?
Right, because they're really the pawns in all this, aren't they? Thousands of customers, often vulnerable ones to begin with.
What's happening to them now?
Well, it's chaotic, We're already seeing reports. The Texas DMV is investigating over 150 consumer complaints, things like problems getting titles, registration issues.
Major headaches.
Huge headaches. And the really cruel part,
Yeah.
the bankruptcy trustees are apparently telling these customers, just keep paying.
Keep paying into this bankrupt, federally investigated company.
Keep paying those high-interest loans.
Yeah.
It's a pretty terrible situation for them. It just layers more harm onto people already struggling.
So this whole tricolor collapse, it's not just some isolated fraud case then?
No, I think you have to see it as like the inevitable explosion in this really over-leveraged subprime auto market, fueled by that great squeeze we talked about.
So wrapping this up, what does this mean for you, the listener? It feels like this meltdown is forcing more than just a financial cleanup.
Absolutely. It's forcing a legal reckoning. It's going to challenge how this whole sector operates. This isn't just about getting money back anymore.
It's about potential criminal accountability.
Exactly. Holding people responsible if they really orchestrated this massive alleged fraud.
Okay, so final thought then. Where does this go?
Well, the really big question, the thing to watch, is whether this federal investigation has the power to sort of rip the cover off the entire subprime auto lending industry.
Expose the whole system.
Potentially. Expose the systemic issues, the lack of oversight maybe, and force a much harder look at how vulnerable consumers are actually being treated or maybe even victimized by this whole system. It could get much bigger than just tricolor.
A multi-billion-dollar bankruptcy, a federal investigation, and a $600 million black eye for some of the biggest banks on Wall Street. The tricolor collapse is the inevitable, explosive outcome of the Great Squeeze, forcing desperate consumers into a predatory system. It was the first and most visible sign of a deep rot. But as we warned, it was not the only one. The next domino was bigger, more complex, and hit the industry from a completely different angle, the parts and repair market. But as our investigation revealed, the story of the First Brand's bankruptcy wasn't really about auto parts at all. It was about a high-stakes game of debt, private equity, and shadow banking gone horribly wrong.
Okay, so if you've ever been under the hood, doing your own oil change maybe.
Oh, yeah.
Or maybe just swapping out wiper blades, then you definitely know the big names.
Absolutely. We're talking Fram filters, Trico wipers, Rebestos for brakes.
Exactly. These are like household names for car parts. Real staples.
They are. But here's the thing. They're all owned by one company, First Brands Group. And that company, they just filed for Chapter 11 bankruptcy.
Whoa. Okay. Chapter 11.
And it's not a small deal. We're looking at a staggering $11.6 billion in total liabilities.
$11.6 billion. Okay, let's get into this. Our goal here is really to unpack what the court filings are showing.
Right.
This idea of a shadow collapse where things weren't what they seemed financially.
Yeah, and it gets pretty wild. One of the major creditors is claiming, get this, $2.3 billion is just unaccounted for.
Wait. Unaccounted for? As in poof, gone.
Yeah.
That sounds pretty bad.
It raises huge questions, right, about, oversight and maybe more. And look at the timing. The founder, CEO, and chairman, Patrick James, he suddenly resigned. Just out. Unexpectedly.
Wow. Okay, captain jumping ship mid-crisis. That tells you something right there.
Definitely signals how bad things must be internally.
So that $11.6 billion, you said it wasn't all just regular debt.
No, that's the key. A huge chunk of it involves this complex network of off-balance sheet financing, hidden debt, basically.
So the company selling us like a reliable $12 oil filter was it itself built on super risky hidden financial stuff. That's quite the contrast.
It really is. It's this concept of shadow banking in action.
Okay, explain that. How does shadow banking let you hide billions?
Well, unlike regular banks, these shadow lenders, they're often private firms, less regulated.
Right, less oversight.
Exactly. So they can do riskier deals. They help First Brand set up this whole financial machinery kind of in the background. The filings name names: Evolution Credit Partners, Lucadia Asset Management, Katsumi Global, and Raystone. They facilitated this.
So these firms essentially helped First Brands keep massive loans off their main books to look healthier than they were.
That seems to be the mechanism, yeah. It maintained an illusion of stability.
What's striking here is the cause. We hear a lot about rising interest rates hurting companies. But you're saying this wasn't that. This was self-inflicted.
Absolutely. This was extreme over-leveraging. They borrowed way too much. It was like a ticking time bomb just waiting to go off, really, regardless of the wider economy.
A time bomb. Okay, so how are they keeping the lights on right now?
Well, the court approved $500 million in emergency financing. It's called debtor in possession, or DIP financing.
DIP financing, right?
Yeah.
Like a lifeline.
Kind of. It's mainly just to keep operations going short term, crucially, to keep those 25,000 employees paid while they sort out this mess. It's temporary.
And this fits into that bigger picture we've talked about, right? The great squeeze.
It really does. We saw it with the subprime auto lender Tricolor collapsing.
Yeah, I remember that.
Now it's hitting these huge corporate structures built on, frankly, too much debt. The pressure's moving up the financial chain.
So the big question for, anyone listening who owns a car, what does this actually mean for them?
Yeah, that's the bottom line, isn't it? It could definitely lead to what you might call a part squeeze.
A part squeeze.
Think about it. If First Brands is in bankruptcy, its supply chain gets disrupted. Contracts might freeze. Factories slow down.
Okay.
Inventory for those Fram filters or Robestos brakes could get tight, so your mechanic might have trouble getting the usual part quickly.
Which means delays.
Uh-huh.
Higher prices. Using different, maybe more expensive brands.
Exactly. Shortages, delays, and almost certainly higher costs passed on to you for repairs.
So this whole mess that started in complex finance filings in Texas
In the Southern District of Texas, yeah.
is going to show up right there in your local garage.
Yeah.
On Main Street.
It casts a long shadow. And it really makes you wonder, doesn't it?
Wonder what?
Well, seeing these heavily indebted companies fail, is this it? Is the era of, super easy money, borrowing mountains of cash with lax oversight, is that finally coming to an end?
Something to think about next time you're staring at a simple oil filter box, right?
Definitely something to think about.
Yeah.
The captain abandons the sinking ship. The story of First Brands is the story of the end of cheap money. A business model built on massive cheap debt that became unsustainable in a high interest rate world. And at the center of it all, a Wall Street shadow banker caught in a catastrophic $715 million conflict of interest. So now we have the financing machine for subprime consumers breaking and the parts and repair machine for everyday owners breaking. And that brings us to our Saturday expose, where we connected all the dots. We started the week with a simple thesis, a warning from Jamie Dimon. And by the end of the week, it was no longer a theory, it was a reality.
Welcome to the deep dive. Today, we're cracking open some sources looking at these recent auto company failures.
Right, Tricolor and First Brands.
Exactly. And the story here isn't just, a couple of companies going under. It looks like maybe the first warning sign of something bigger.
Something hidden, maybe? In the shadow banking world. That's what the sources suggest.
Yeah, and the fear, it seems pretty real at the top. We saw that quote from Jamie Dimon this week.
Oh, yeah, the Dimon quote about the cockroaches, right? When you see one cockroach, there's probably more.
That's the one. And it feels like our deep dive today kind of confirms that diagnosis. This isn't isolated.
No, it seems like this debt problem could be, pretty widespread. Contagion is the worry.
Okay, so let's get past the surface stuff, like those subprime loan defaults people heard about with Tricolor. Let's dig into the financial mechanics behind it.
The real engine room drama.
Yeah. And two players really stand out. The investment bank Jefferies and the private equity firm Apollo.
Right. Jefferies first, maybe? Their situation with First Brand seems like a catastrophic conflict of interest.
Okay, break that down. What was the conflict? How were they trapped?
Well, first off, Jefferies wasn't just advising. They were a huge creditor themselves. They had, get this, $715 million of their own money directly tied up.
$700 million. Wow. That's massive exposure for them personally.
Massive. And it was in one of those off-balance sheet funds, kind of hidden from plain view,
Right. Okay. Hiding the risk. But where's the conflict exactly?
Here it is. At the exact same time they had all this money at risk, their investment banking arm, They were out there trying to raise more money for First Brands.
Wait, raise money for the same company they knew was potentially sinking their $715 million?
Precisely. They were trying to sell $5.2 billion in new, very high-risk debt. It's called private credit.
Private credit, so non-bank loans, basically. Is that even allowed? Selling debt for a company you're massively exposed to.
Well, allowed is tricky. It's largely unregulated. The Wild West, really. And that combination, their own skin in the game, plus trying to sell new debt, that's the smoking gun.
It really shows the structural weakness, doesn't it?
Yeah.
Selling tickets for a voyage they suspected might hit an iceberg.
That's a good way to put it. They knew the risk better than anyone.
Okay, so Jeffries is stuck. But you mentioned Apollo. They represent the other side. The smart, maybe predatory money?
Yeah, Apollo. They played a pretty ruthless double game here. Textbook, almost.
Double game. How so?
Publicly, if you look them up, they were listed as a major lender to First Brands. Looked like they were supporting the company.
Okay, standard stuff.
But behind the scenes, privately, they were placing huge bets against First Brands surviving. A massive short position, essentially.
How do you even short a private company like that? Especially if its loans are, blacklisted from normal trading.
Good question. You can't use the normal stock market tools. So they went into the darker corners of finance, custom credit default swaps. CDS?
CDS. Like insurance against default.
Exactly. It was basically a tailor-made insurance policy that would pay out big time if First Brands went bust. Since the loans weren't really trading, this CDS was their only way to make that huge bet against the company.
So that was the tell, right? The smart money saw the collapse coming way before it hit the news.
The ultimate tell. Apollo knew.
So if these auto failures are just the first cockroaches, like Diamond said, where's the rest of the colony? What does this mean for the wider system?
Well, the fear is definitely spreading. Just look at the regional banks this week. The KRE ETF, the Regional Banking Index.
What happened?
It dropped over 6% in one day. That signals real panic on Wall Street. They're scared this risky private debt is, everywhere, especially in those regional banks.
Is there a root cause tying all this together? Why now?
Absolutely. It all comes back to what some are calling the Great Squeeze.
The Great Squeeze.
Yeah. Meaning the end of cheap money. For a decade, the Fed kept interest rates near zero. That easy money fueled this whole shadow banking world, let companies borrow insane amounts.
Right, the zero interest rate party.
And now the party's over, rates are high. These companies loaded with debt suddenly can't afford the interest payments, they can't refinance.
So they just collapse.
It's like a withdrawal, a really painful, violent withdrawal from that cheap money drug. The whole system is starting to convulse.
So wrapping this up, these car company failures, Tricolor, First Brands, they're really just symptoms.
Symptoms of a much deeper sickness, yeah. Rooted in this unregulated shadow finance stuff.
And the actions of Jeffries, with their conflict, and Apollo with their clever bet, they basically exposed how shaky that system is.
They really did. The Great Squeeze has its first victims.
And it feels like this unwinding, this withdrawal, is probably just getting started.
That leads to the final thought, maybe for you, the listener, to consider. We've seen the auto sector get hit.
Right.
As the system keeps going through this withdrawal from cheap money, this Great Squeeze, what other industry, maybe one much bigger than auto parts, is sitting on a mountain of debt it suddenly can't refinance? Who's next?
And that's the full picture. The dominoes are falling, and they are all connected. The Tricolor collapse, the First Brands bankruptcy, they are not isolated events. They are symptoms of a system under immense stress. And the 9% plunge in the regional banking index this week shows the fear of that stress is spreading. Mainstream gave you the snippets. We gave you the full investigation. And as I said at the start of this week, this is only the beginning. That's our show. Thank you for tuning in to Confessions of an Insider. You can find all the articles and data for everything we discussed on theloganzone.com. Stay sharp, stay informed, and stay tuned. We'll see you next week.